Hey, how's it going, everyone? So, the other day I was showering naked and then I got curious about something. Do you know which companies have performed the best in the stock market since 1926? I guarantee you will not know the answer. But before we talk about the best dividend compounders in stock market history, let's talk about the benchmark that investors like to compare their portfolio's performance to, the S&P 500, often referred to as the market. Since 1926, the average annualized return has been 10%, meaning your money would have grown 10% each year. But as you can see by the graph on your screen, sometimes it would have dropped by 45%, and other times it would have gone up by 50%. And despite the crazy headlines or people saying this can't last forever, time and time again, the market goes up. So if you invest into the market and your portfolio goes down by 20% during one of these disasters that you see on your screen right now, in the grand scheme of things, which is like 5 to 10 years, you will most likely be in the green with the S&P 500. So when people tell me only investing into US companies is nonsense, I just shrug my shoulders and tap my butt. The data tells me the US market is resilient and finds a way to bounce back from every single recession, depression, and disaster. And call me arrogant, ugly, or stupid, but I just don't feel the need to invest into anything international based. Whatever you decide to call me, just know that your wife's boyfriend calls me a friend. Needless to say, if you are watching this video and you choose not to invest into the stock market, you do not make sense and you probably sit down to urinate. But jokes aside, please pay attention because this is important and it's going to be the metric that we're going to be comparing the other companies to. Let's talk about the value of a dollar invested into the S&P 500 since 1926. That single dollar would have gone through puberty and graduated college and eventually turned into $15,800 by 2024. That's the transformation of a dollar into the S&P 500. But the fact of the matter is, most of us gorillas that are watching this right now, we would have sold that $1 investment when it turned into $10 and then regretted it for the rest of our days. True story, I'm an idiot that sold out of Nvidia and Broadcom a couple years ago when my investment was up by 100% because I thought to myself there was no way it could go any higher, and then it went up by like another 300, 400%. So having a dollar turn into 15 grand is a pretty good deal, right? If you tap the like button on this video, I will not tell your wife that you've been using the hair clippers to trim your balls. Come on, man, you don't even hesitate to tap like when half-naked guys appear on your Instagram homepage. So do me a solid and tap like. Jokes aside, check this out. So now we're going to be looking at the top performers that have the biggest wieners in the locker room. These are some of the best performing stocks of all time. And before you leave an angry keyboard warrior comment, this is going to be objective data that was recently published by a researcher named Hendrik Bessembinder. Okay, whatever. His name is right here. And basically, he looked at more than 29,000 stocks between the years of 1925 and 2023 to find out which companies had the best performance. First up is going to be CVS. Currently, it's down by 27% year to date. It has a 4.5% dividend yield with a sustainable 34% payout ratio. Its fair valuation is $93 a share, and it's currently trading for about $58. And if you think CVS is just a retail pharmacy company, you are probably the same type of person to eat cereal with water. Like, that's disgusting. If you don't want to stay disgusting, then please watch my analysis video on CVS to learn why I think it has potential, but is also on the riskier side. If you would have invested a single dollar into CVS, it would have grown to $46,000 over the years in this time period, and it would have grown at a rate of 11.9% year over year. As a benchmark, remember the S&P 500, that single dollar would have turned into $15,800 in roughly the same time period. Next up is the Hershey Company. Currently, it's up by 2% year to date, and it has an average looking dividend yield at 2.7%, and it's currently trading for about $196 a share. I personally think it's slightly undervalued, but I could be wrong. Watch my analysis video to find out more.
Could you stop recommending your own videos? My goodness.
Ah, shut up, Jim Bob. With an initial $1 investment in 1927 into Hershey, it would have turned into $69,000 over the years. That's a 12% annualized return. And I'm telling you, Henry, the numbers are only going to get bigger and bigger. So stick with me. Did I say Henry? I meant Jim Bob. Next up is PepsiCo. It's currently up by 1.7% year to date. It has a respectable dividend yield at 3%, and they have been growing the dividend for 51 years straight. And fun fact, some of the best chips in the chips aisle, Flaming Hot Cheetos, yeah, it's made by Pepsi. A dollar invested into Pepsi would have yielded $86,000, which I think is pretty cute. And I already know what you're thinking. What about Coca-Cola? Well, hold your horses, because now we have Coca-Cola. Currently, it's up by 16% with a 2.7% dividend yield, and they have been growing the dividend longer than you've been alive, 61 years. They also produce my favorite milk in the dairy aisle, which is Fairlife. It has half the sugar and double the protein when compared to normal milk. And for a gym rat like me, I appreciate the extra protein. I genuinely hope that Fairlife never goes out of business. It's quite literally the only milk that I'm willing to drink. And here's where the money gets ridiculous, because a single dollar invested into Coca-Cola back in 1925 would have transformed into $120,000. This is one of Warren Buffett's favorite stocks for a good reason. They have a business model that is always in demand and a dividend that is just cute. I don't know why I keep saying cute. I guess it's delicious. And before we reveal the best company in stock market history, today my Tottenham Hotspurs beat Everton by 4-0 in the Premier League. Honestly, I can't believe they made such a bounce back from the week prior. The only real difference is that we didn't have Solanke as a striker, and we did better without him, which is weird. I guess Angie watched my last upload and coached the boys up for some proper soccer.
It's not called soccer.
Oh, shut up. It's soccer. I'm an American. My boy Sonny scored 2 goals as a 32-year-old. And if you're not into soccer, I'm telling you, man, it's not too late to get into it. Now back to the video. The tobacco company, Altria, is the pound for pound best investment since the stock market has been going on. Currently trading for about $52 a share, and the dividend yield is really juicy at 7.5%. It's up by 26% year to date, and according to Morningstar, it's still undervalued. And just thinking about their dividend just makes my nipples hard. And you know, speaking of nipples, women wear a bra to cover up their nipples and to support their boobs, right? So my question to you is, do men with pepperoni nipples do anything to prevent it from ripping through their shirts? I say that because I'm in the market for t-shirts right now, and a lot of the reviews mention the whole nipple coverage thing, and I just can't help but laugh. I mean, I guess if your nipples are really long, you could just put a band-aid over them and then put your shirt on, but what do I know? But hey, a 7.5% dividend yield. Now, this is what I call funny money. A single dollar invested into Altria in 1925 would have ballooned into $2.6 million. That's if you reinvested all the dividends. My goodness gracious, a single dollar turning into 2.6 million? Wow. Just wow, that's an annualized return of 16% year over year. Remember, the S&P 500 is 10%, which I think is pretty good. But 16%? Man, and check this out. Despite how you might personally feel about a company, do not let that be the reason why you miss out on a winning business. I hate Altria deep down inside because of what their products do to people. But when it comes to investing, I put my personal feelings and emotions to the side. I try to look at companies objectively, and when I look at Altria's finances, balance sheet, and dividend history, nothing short of fantastic. It's like that straight A student in school, just spectacular. And when we look at the past 20 years, the stock has gone up by 2,300%. And I'm going to be fully transparent with you. I am an investor of Altria, and I'm up by a lot, but I'm still not going to sell anytime soon. With all that said, what about the other side of this? Based on Hendrick's research, more than 51% of stocks have had negative outcomes in the US stock market. So let's go ahead and talk about that. There's so many companies in our history that were at the top of their game at one point, but also those same companies disappeared overnight, like the ones that you see on your screen right now. That's why an exit strategy is so important. And because of that, I don't believe in the idea of buy and hold forever. Buy and hold long term, like 40 years? Sure. 30 or even 20 years? That makes sense. But forever? I don't know. Because I think it's good to periodically reevaluate your investments to see if you still believe in their mission and future. If a company changes its fundamental business model and it makes you feel uneasy or their business economic moat disappears, then it's a good reason to sell out of it. And if you feel like a company has ballooned up in valuation and is now overpriced, maybe the game plan is now to sell out of it and buy shares of SCHD or some other ETF. My personal plan when I retire is to go all in on ETFs, but as of right now, that's not the priority. And let me say why. If you ever wonder why I like to pick individual stocks to invest into, that's because I am delusional. I'm weird, I'm crazy, I'm stupid. And I feel like I am investing into the winners of the stock market, which are dividend compounders. I could absolutely be happy with a safe and steady 10% a year with the S&P 500. But the idea of beating the market while getting a juicy dividend is a fun hunt. Please do not judge me on what I like to do, because I don't judge you for your nipple piercings, pal. When it comes to piercings, I just have no idea why anyone would want to pierce their nipples or even their balls. Like, those are the two areas of my body where I'm just like, no, that's off limits. If you want a thorough, detailed response as to why I'm a hypocrite and why I tell others to do ETFs even though I pick individual stocks, then watch the video that I made justifying my thought process. It's called Is an ETF Better Than a Stock? But if you haven't noticed, every single company that we looked at today was a dividend compounder. And I know I keep saying dividend compounders, but what do I mean? Dividend compounders are companies that have an investing thesis that writes itself. These are companies that are high quality, predictable, and are growing year after year. Their free cash flow, growing. Their top line, growing. Their bottom line, growing. Their earnings per share, growing. But more importantly, for the dividend to be sustainable and reliable. At this point, I could literally write an essay as to why I prefer dividend paying companies rather than those that do not. So in short, I personally prefer dividend compounders, but I know other people prefer speculative growth stocks that are all or nothing. And when I say all or nothing, you know exactly what I'm talking about. But I mean, at that point, you might as well just get really drunk on some cheap beer and harvest your left kidney to sell on the Oregon market. Because I'll tell you what, that will probably give you a safer return than going all in on speculative growth stocks. But jokes aside, if a company has crappy finances and they're not profitable and they don't pay a dividend, I do not even bother with them. It's not even worth my time. So the takeaways from this video is that long-term investing into high-quality companies is a winning recipe, and that an exit strategy is equally as important. Because at one point, the investors of Kodak or even Blockbuster, they had huge gains, but eventually these companies went bankrupt and they disappeared. So an exit strategy is important. On that note, the companies we looked at today have been successful for the past 100 years, and I think each one of them will be okay going forward. I'm talking about the Pepsi, Altria, CVS. But their days of exaggerated growth are probably over, except for Altria. So for me, I'm pretty bullish on tech companies for the next 30 to 40 years. When it comes to big tech, I think there's plenty of room for growth, unlike your favorite pair of pants that you refuse to donate. I'm so sorry, man, but you're way too fat to fit into those. And if you're still watching, then you should check out my videos on which sectors and industries are going to be the best. With that said, have a good day, my friends. Stay safe. Amos signing out. See you guys.